Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat.
Paris milling wheat. 12 weeks ago I pondered on this market and my musings then were thus, and I quote, "Take a look at the whole big action since the peak in May to date as possibly, just possibly, a very large bearish halfway hesitation in the making." To clarify, it's possibly in the making and is not made, not yet. This is a ginormous pattern and one that will eventually lead down to something like the 225 area. I'm not prepared to call it that, not yet. However, we may have another bearish but less aggressively bearish pattern, though not necessarily by much. It is a mid-June to date bear channel, currently 243 to 319, that's what it is at the moment, which is highlighted in bright green on my daily chart. I'm not saying either of these two will be the way forward, but if you favour the bearish side, then these are worth considering. Obviously, these still stand, and both have merit. Indeed, the lower bear channel line turned the market higher last week. To this, I added 6 weeks ago a further short-term pattern, and one that's worked pretty well. It is a mid-November to late December 2022 bearish shift pitchfork. You can see it highlighted in purple on my daily chart. This had been previously breached, but had repaired itself until last week when it was breached again, with prices punching down through the lower time, currently at 254, but then found itself dropping into a whole load of supportive congestion between 258, 260, containing the 2022 low at 258.5, then again between 252 and 255, containing the 2013 high at 253.5, then at 250 and finally at 247. Prices finally halted their decline in the 245 area, which is where the lower bear channel line was then at. The earlier supports eroded the bearish incentive, but that lower bear channel line in bright green finally stopped it and turned it back up again, back up into the broken bearish shift pitchfork. The questions now facing this market is whether this move higher has been enough. Will also the bearish shift pitchfork repair itself, or will it fail and we rely solely on a big bear channel? Last week, the action threw up more questions than it has answered. This week, well, we have a tentative yes, it has seen a recovery back into a bearish shift pitchfork. Now, I emphasize the word bearish there. But overhead, we not only have the middle time to deal with, which is currently at 265, but also a compact congestion area between 267 to 271. Maybe here, as perhaps we have seen in other grain markets, we may see a realignment to a shallower bearish channel or wedge of pattern of some form, or even just a wider one. Unfortunately, it's a little too early to just tell just yet. It's very much watch and wait. London, UK feed wheat. This market, as elsewhere in other grain markets, had a choice of avenues going forward 16 weeks ago. Eventually, the market chose, as I described it back then, and I quote, "a straightforward move down with potential targets for the break below the bull channel." In this case, a primary target on the downside was already achieved in the 269 zone, whilst a secondary, harder to reach target, X1, is almost achieved in the 239 zone. End of quote. Prices finally dropped down in early December and reached the secondary target in that 239 zone. I also laid out at the same time the next possible scenario, and I quote, "We now have to see if the 239 zone will hold this decline, which includes the previous all-time high at 238 3/4. If it doesn't, then there is a series of old congestions, some dating from 2012, between 230.10 and 223.10, and another dating from 213 between 215 to 217.80. These may in turn be in the frame, but let's first see what the 239 zone holds in store." End of quote. Well, once reaching 239, prices hesitated, but in early January, they resumed their journey lower. It is at this point that I will bring in my last words from 16 weeks ago, of what was at the time a new pattern, and I quote, "There is one potentially new factor to add into the mix. I'm not even sure if it is genuine or not as yet, but we may have an October to date small bear channel. The one thing it has in its favour is that the short medium moving average, that's currently at 220.05, seems to be paralleling it, and that's the end of the quote. 8 weeks ago I added a shallower amended bear channel, which you can see highlighted in bright green, as it seemed a better fit because of the breach above the upper bear channel line of the original purple bear channel. And that's at the end of 2022. Then 5 weeks ago also, the top side of this bear channel began to be attacked with a weekly key reversal up. As they are no longer directly influencing the market, both bear channels will be relegated next time. Then, yet more things happened, as the market punched up through the declining short medium moving average up to the old previous all-time high at 238.80. This old previous all-time high capped the rise, and from mid-February down to last week, we saw a drop down through the January low at 217.25, as well as the 2013 high at 215 even, the 2022 low at 206.5, and the March 2013 high at 205.05. Prices continued declining until last week, just when it looked like we might still be heading lower. Prices then reverted back up. This was initially somewhat of a surprise, as the market was in an area seemingly devoid of significant supports. I can only think that perhaps one or more of three possibly supportive factors may have caused the reversion back up. These are, and they are in no particular order, the September 2021 lower at 181.70, the possibly powerful 50% absolute Fibonacci line at 180.5, and item 3, something I'd introduced 8 weeks ago, target X at 180 even. You see, I asked the following question back late last year, and I quote, "What of the action since mid-May to date is a huge bearish halfway hesitation, a really, really big one? In that case, we would have to look at potential down in the 180 area. Yes, 180. I'm not as yet advocating this as a pattern, but it might turn out to be so. It will depend on how the market treats the congestion between 230 and 223, and the smaller ones between 215 even and 217.80, and also between 205 and 206.40. Watch carefully, especially the integrity of the bear channel in purple." End of quote. Well, we know what happened to the bear channel in purple. 8 weeks ago, I decided to place a potential target X in the 180 area. And what is interesting about target X is it's right by the previously mentioned 50% absolute Fibonacci line at 180.5. Perhaps these, however distant they may have seemed from the market, the influence of these two caused a halt and a move back up. The action also allowed me to draw a new bearish Andrews pitchfork for the very late October 2022 to February 2023 move. I'm not wholly wedded to this pitchfork, as neither the upper tine, currently at 214.25, nor the lower tine, currently 179.5, have been tested. And the middle tine is not looking that great either. That's currently at 196.85. However, in the absence of anything else, I am minded to watch this pitchfork for now.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.